Hello, dear students. I'm happy to see you again, and we will start our next session in the course of investment project management. And to begin with, I would like to share with you the list of homeworks that I have received. We have, let me show. So you can see that here is a list of your group with the credentials shown and the submission status that marks meaning that I found your mail in incoming folder. Probably some of your mails get lost, or I should look for it more thoroughly. So I now will send this file to the chart and give you 10 minutes. So please look through this file, and if you didn't find the Y sign against your name, but you sent the file to me, please let me know, type in the chart, and we will see and try to find your mail. So if any problems, let us check it right now. So now I will put the file here. Open the file, the tab HW, and check if you are on the list. So 10 minutes for all of you to go through. Probably someone will only connect to the chart, but please check if everything is fine. Okay, so probably all of you who are now at the call have the time to check that you are in list. So I will answer to the last question from Alex Kostner. Yeah, you're on the list. Please check this HW1 tab. So as a result, we have now 29 from the group MF Yan and of 48 and 5 from additional students. So please, again, I kindly ask you to give this information for your fellow students. Probably some of them have no time or opportunity to take today's session, but he or she submitted the homework, but I, for some reason, didn't find it. So please check and give the information to your fellows. And if someone still wants to submit the home task today, it is a final call. So by the end of the day today, I will close to accept any homeworks. Again, let your fellows know that they have a final chance to submit the homework today. Or if they submit it, but they are not indicated in the list, please send me a mail or type in the chat. Okay. Let's move to the last session, and we have some slides left to discuss. So continue to consider the code generation project, we have to discuss the cash flow projections. And the cash flow projections assumptions for the code generation project are shown in this table. You can see it now. The contract volumes of electricity are specified in the electric power purchase agreement, and the steam as specified in the steam purchase agreement. They are established the base output levels for 15 years, and the electric power purchase agreement specifies electricity prices. The steam purchase agreement provides a base steam sales prices, which can be escalated using forecast of future changes in PPI. The projected volumes and prices can be used to forecast annual revenue amounts. The design of the cogeneration facility will determine the annual levels of gas usage. The gas supply agreement escalates the gas price to match future increases in electricity prices, which were used to prepare the revenue projections. And the management fee and other operating expenses will also increase with the PPI, and management fees are included in the line operating and other cash expenses in this table. Also, I have the table 3 that contains projected operating cash flows. They are based on the assumptions provided in the previous table. And when prepared a set of cash flow projections for a prospective project, it is important to give all the critical detail. Prospective lenders and equity investors are particularly interested in the assumptions because the projections are meaningful only to the extent the assumptions have a sound basis. What type of values for money data we shall use? So surely, if we denote the money in dollars, shall we use a constant dollars or a current dollars? So shall we take into account the time value of money, or at least inflation index? An error frequently committed when making cash flow projections involves escalating revenue items at one rate and cost items at another rate, without any real justification for doing so. When these escalation rates differ, it is important to furnish an explanation along the projections. Escalating revenues at a higher rate than cost will introduce a basis in favor of proceedings with the projects. An economically unprofitable project may then appear to be profitable. And then it's really sometimes some kind of technique, so like financial modeling magic, some analysts used when preparing the financial model. So just consider then you have very same level of or inflation index, then you can apply both for revenues and the costs of your project. And if you can use a higher level of inflation, given all the other drivers constant, so you will receive the higher financial results for each period, and subsequently the higher financial cash flows, while you will leave the, for example, weighted average cost of the capital or required rate of return the same. That will lead you to a higher NPV. And please be aware of such financial tricks that can be used. So if you increase only inflation driver, even if it is the same both for revenues and costs, but you do not adjust other drivers used in a calculation, that's not a sound approach. So if you have several scenarios in your financial model, That means that switching from one scenario to another leads not only to changing one set of drivers like inflation, but also all other drivers. And in this case, if you are in some scenario expecting a high inflation levels than in another, that will also mean not only to adjust inflation indexes upwards, but also to increase the weighted average cost of the capital, as it contains a component of risk-free rate that should be higher in scenario with high inflation projections. And also the same approach applies to the required rate of return. So please be aware of this financial magic that can be used. And some financial economists recommend preparing the projections for a project on the basis of dollars of constant purchasing power, or simply constant dollars. Constant dollars differ from so-called current dollars, which is the unit of measurement employed for the code generation project. In that constant dollars, we have the effect of general inflation removed. Many companies have found it useful to prepare cash flows projections in constant dollars when evaluating a project that would be developed in a high inflation economy and would have certain critical revenue or cost items received or paid respectively in a local currency. When a project's revenues and costs are all denominated in a single freely tradable currency, and the inflation rate in the country has issued, the currency is comparatively low, no more than a single-digit rate, the extra work required to prepare the projections on a constant dollar basis is seldom justified. A better analytical approach is to specify the inflation assumptions, as in our previous table with all the assumptions, and then show the effect of different inflation assumptions in a sampled sensitivity analysis. A project's initial capitalization table shows the financial condition for the project. The cash flow projections will indicate how profitable the project is expected to be, how much cash flow it is expected to generate, and how the cash flow will be allocated along the various providers of capital. These projections can also be used to predict how the project's financial conditions is expected to change over the life of the project. And consequently, the initial capitalization table can be used in conjunction with the information underlying the cash flow projections to prepare a set of projected financial statements: income statement, balance sheet, and statement of cash flows for each year of the project's life. And again, there is a difference between approach for the project finance and general corporate finance. While in a general corporate finance, it is more essential for you to prepare the sound, detailed cash flow statement, because it is the cash flows that will be used in analysis of effectiveness of the project. But in a universe of the project finance, the balance sheet form and the income statement is also important, because you are lending money from the banks, for example, and they will include some ratio provisions in the lending agreement, meaning that you should maintain some specific interest debt or debt service ratios, or some maximum leverage levels of your balance sheet. And the lenders will directly address balance sheet, income statement to evaluate such ratios. So that is a characteristic feature of the project finance when you have to prepare soundly and in detail, not only the cash flow statement form, but also in balance sheet form. and the income form. Okay. Again, I'm kindly ask you to address not only these slides, but look at the Excel file called Code Generation Project, where I prepared all these tables, both for assumptions, financial statements, different ratios, etc. That it is all done in Excel with the corresponding formulas used, and it is also a real, so it's not artificial, it's a real modeling tool that can be used to justify the project's economics. Okay, let's switch back to the slides. And the other very important aspect of the project finance, its debt capacity, because you are financed via debt. The amount of debt a project can support depends on the amount of cash flow that is available to make debt service payments, the extent of supplemental credit support mechanisms, and the loan parameters, the interest rate, the maturity date, loan amortization requirements, and the lender's coverage requirements. Okay, let's look at detail. Borrowing capacity. We can use various models for gauging a project's borrowing capacity. The cash flow information contained in the previous table, table 3, and we can use it to determine the borrowing capacity of the cogeneration project. The present value of the projected cash flows for year 1 through 10, calculated at a 10% discount rate, is 165 million. Suppose that the long-term lenders require a cash flow coverage ratio of alpha equals 1.75, then the maximum borrowing capacity is 94 million, which exceeds by a comfortable margin of 85 million initial debt level planned for cogeneration projects. So you have to first analyze your cash flow, and on the basis of these cash flow projections, identify the maximum level of loan given the discount rate acceptable to the lender. And then also you should consult with lender and understand either specific requirements for this lender or some market average or market medium requirements like 1.75 debt ratio, cash flow coverage ratio. And this will lead you to an initial estimation about your borrowing capacity. Then you have to think about the annual coverage tests. 3 coverage tests that lenders apply to measure a project's capacity to pay debt service year by year. The interest coverage, fixed charge coverage, and debt service coverage. The table here shows the annual interest coverage and debt coverage ratios for cogeneration project. The cogeneration company does not plan to rent any equipment, so the fixed charge coverage ratio will be identical to the interest coverage ratio. If, however, cogeneration company did decide to rent significant amount of equipment or real estate, then a fixed charge coverage ratio would have to be calculated for each year. The interest coverage ratio increases steadily as the project loan is repaid. The debt service coverage ratio decreases in those years when the principal repayment increases. Lenders are most concerned with the values of this ratio during the early years of the project life. For the cogeneration project, the interest coverage ratio is 2.13 in year 1 and exceeds 3 in year 4. The debt service coverage ratio is 1.89 in year 1 and never falls below 1.64. In use of the strengths of the cogeneration project contractual agreements, coverages of the magnitudes just calculated would suggest that cogeneration company should be able to service its debt in a timely manner. And also I should notice that these thresholds set for the interest coverage ratio or debt service coverage ratio is really good representation of average ratios used in the market. So you can already use these ratios as a reference when analyzing the similar projects. Interest rate risk. If the debt incurred for a project that bears a floating rate of interest, rising interest rates can impair the project's coverage ratio. A different form of interest rate risk also exists. At the same time, a project is initially financed, floating rate bank debt is often arranged to cover construction costs. The expectation is that it will be refunded with fixed rate debt following completion. But if interest rates rise during the construction period, the fixed rate long-term debt will prove to be more expensive than anticipated. A number of strategies are available for handling these risks. First, the construction loan can be arranged so that the portion that is not repaid with the proceeds from the equity financing turns into a term loan. The term loan can be refunded if interest rates decrease, but interest rates might not decrease for several years. Hence, this strategy really does not reduce the project interest rate exposure. Alternatively, the interest rate risk can be hedged. Selling financial futures contracts short during the construction period is one hedging strategy. If interest rates rise during the construction period, and if the hedges have been structured properly, the profit realized on closing out the financial futures positions will offset the impact of the higher interest rates on the project's cost of debt. Later, we will describe various hedging strategies and how to implement them when we will talk about the handling of financial risk. And at this point, I again want to make a reference here to other course that I conducting. It is the alternative investments, and you can see that here the application of these hedge funds and manager future strategies. So here the managers of this investment project can address hedge funds or dealers to provide diversification of its risk by establishing a hedge against unanticipated moves in interest rates. An alternative hedging strategy that is used for locking in future fixed rate of interest utilize a deferred interest rate swap arrangement. The project company could obtain protection against a possible increase in interest rates by entering in a deferred swap contract under which the project company would agree to swap interest payment obligations with the counterparty to contract beginning as of the completion of the project construction. So when we will complete the construction, we will enter to the swap, and the project company's obligation would be calculated at a specific fixed interest rate, and the counterparty's obligations would be calculated based on a specific floating interest rate. That is, a deferred swap contract establishes the term of the interest swap at the date of the contract is entered into, but the start of the swap period is delayed for some agreed on period. So You now agree to burn the terms of exchanging your floating interest rate risk with the counterparty who is the provider of swap, but the swap will be effective only after you complete the construction. And deferred interest rate swap contracts we'll also discuss in a session regarding the risk management. And what it leads to? It leads to the calculation of returns. The projected operating cash flows in table 3 in the previous slide form the basis for measuring the expected rates of return for different parties of the project, that is engineering firm, local utility, and the passive equity investors. Engineering firm and local utility invest identical amounts. Recall this finance and equity structure that we have. Each have the same expected rate of return. And I refer to it as a rate return to sponsors equity. So the portion of the equity that provided by sponsors. And I refer to the expected rate of return to the passive equity investors as a return to limited partnership equity. So just to distinguish between the limited partners and the general partner. The latter is easier for to calculate, so we will consider it first. Return to limited partnership equity. The passive equity investors as limited partners are junior to the lenders. They receive cash distributions out of what is left up over the cogeneration company pays the debt service for the year. So the company first have to service the debt and then to distribute the what is rest. The size of the cash distributions is not specified contractually. It depends on the profitability of the cogeneration project. The passive equity investors also receive their share of the tax benefits associated with project ownership, plus a share of cogeneration project's residual value. To realize these benefits, the passive equity investors had to commit to the project, to the construction, or lenders to invest a stated percentage of the project's equity capital once the cogeneration project passes its completion test. So again, to receive these benefits, you should commit and invest the equity capital as agreed after the project is committed. And as illustrated here, the limited partners are entered into the project with obligation or so entitlement to receive 90% of income, losses, and the cash distributions from the cogeneration projects prior to reversion, and only 50% of these amounts thereafter. So the passive equity investors are entitled totally to 55% of these amounts, both before and after reversion. And thus, prior to reversion, passive equity investors will receive 50% of income, loss, cash flow, and after reversion, they will receive 97%. That's the difference between the passive investors and active, so the general partner. And in this table, we can see the details of the calculation of annual after-tax returns to the passive equity investors. The expected rate of return is calculated at the internal rate of return of the after-tax cash flow stream. This calculation assumes that the passive equity investors' share of the cogeneration project's residual value net of related taxes equals 35 million. In particular, it is assumed that the cogeneration company can be sold at the end of the 15th year for a price equal to 5 times the year 15 after tax cash flow. Again, reference to the evaluation of portfolio companies from the course of alternative investment. You can see here that the valuation applied to this project, that portfolio project in its nature, after 15 years is a multiple to its net income. So you can see that here we have an assumptions that the average applicable multiple for this industry is 5. So it means to calculate the residual value of the project in year 15, we multiply the after-tax cash flow by 5 and receive the valuation for this project. But again, the certainty of this valuation is really debatable. The expected rate of return for the passive equity investors in a cogeneration project based on the after-tax cash flow stream is 40%. So they will agree to invest in cogeneration projects only if this expected rate of return is no less than the rates of return they could expect to realize by investing in projects of comparable risk. And I should say that taking into account all the considerations and assumptions about this project, the total return rate of 40% is quite enough, because the risk of this project, given the all contractual agreements that we have at hand, are really below the average for the industry. The timing of the equity investment affects the investor's expected rate of return. The passive equity investors in a cogeneration project will have to commit to invest their equity prior to the start of construction. And then this table treats the equity investments as occurring at the time these equity commitments are funded. That is, just prior to the start of the operations. It can be argued, however, that the equity investment really occurs at the time the commitment is made. The truly correct approach is not entirely clear because the passive equity investors will not have to fund their commitments unless and until the cogeneration project passes its completion tests. If the expected rate of return is calculated based on when the commitments are entered into, the passive equity investors' expected rate of return is 25%. And the passive equity investors often perform a third expected rate of return calculation, in which they assume that their equity investments are made as construction proceeds and represent the percentage of the total project cost that they have effectively agreed to fund. Equity will represent 25% of cogeneration company capital structure. The passive equity investors will provide half of this amount, and the passive equity investors, under this conservative approach to measure their expected rate of return, would treat their equity investments as taking place as construction and related costs occur in amount equal to 12.5, that 1/8 of these costs. And under this approach, the passive equity investment occurs at a construction year -2 and then -1. These investment patterns lead to expected rate of return of 29%. So again, please consider the various approaches to calculate the return for the limited partners equity. We have table 7 that summarizes the expected rate of return analysis for the passive equity investors, depending on how the passive equity investors view the timing of their equity investments. The expected rate of return falls between 25% and 14%. If the required rate of return is 15%, the expected net present value falls between 13 million and 21 million. The net present value remains positive even when the required rate of return is 25% and the equity investment is treated as occurring coinciding with the initial commitment to invest. And again, in our Excel spreadsheets, I will switch now to the Excel. You can see we have a special page for calculating the return for limited partners. So I again highly asking you to address this table. We can check the calculation. It will help you in understanding how the actual calculations can be done and probably use in your professional life. And also we'll have the various sensitivity tables to discuss later. But now I'd like to give you a break for 5 minutes, and we will continue with the rest of this code generation project. So let us meet in 5 minutes. Okay, let's continue and calculate the return to those who are most interested in a project, so the return to a sponsor's equity. Engineering firm and local utility have equal ownership interest in a cogeneration corporation, the general partner of cogeneration company. Cogeneration corporation owns 10% of the equity in cogeneration company. It receives 10% of the net of the income, losses, and cash distributions of cogeneration company until reversion occurs, and 50% thereafter. In addition, engineering firm and local utility each own 22% of the limited partnership interest in a cogeneration company. For managing the business of cogeneration company, local utility will receive a management fee equals to 10% of project revenue. Local utility estimates that this management fee will approximate its cost of managing cogeneration companies, so no profit will be generated, so no additional profit stream. Like these passive equity investors, engineering firm and local utility will commit to fund their equity investment prior to the start of the construction period. And this table shows the annual after-tax cash flow to the sponsors, engineering firm, and local utility. Please note that in this table, the sponsors will receive 50% of profits, losses, and the cash distributions prior to reversions, but they will receive 72% after reversion. The sponsor's expected rate of return on equity exceeds the passive equity investor's expected rate of return. That's often the case if a project goes well. That is to be expected because the sponsors greater risk exposure as general partners and should be rewarded greatly. Again, to these tables. So we have various tables from the 2 to 7, and they contain results for expected case, but results rarely turn out exactly as expected. So for the cogeneration project, the residual value is uncertain, what I'm talking about. Also, unless some form of interest rate protection is arranged, the interest rate on 10-year debt service is uncertain. On the other hand, the construction contracts eliminates uncertainty about with regard to the construction cost. During change and design changes that could affect this cost, but the cogeneration project is unlikely to require significant design changes because it will utilize a planned design developed previously. The 15-year electric power purchase agreement and 15-year steam purchase agreement mitigate output price increase. This is still a risk that revenues might fall short of expectations because of unplanned outages. However, this risk is small because the operating reliability of similar plants have been well documented. The 15-year gas supply agreement eliminates gas price risk. If these contracts were not in place, then a sensitivity analysis would have to be performed for each of the factors mentioned: construction cost, electricity price, steam price, gas price, and the levels of electric power and steam output. Residual value from this. Okay, I will switch to the Excel file here. Just a minute. Excel. So we can calculate the effect of different interest rates on various ratios important to lenders, like interest coverage and debt service coverage. And the table here, this table, illustrates the sensitivity of the interest rate coverage ratio and the debt service coverage ratio in years 1 to 4. The changes in the interest rate on the debt issue, even if the interest rate on this debt should increase to 14%, like here you can see. The interest coverage ratio during the first 4 years never falls below 1.25, so it's a minimum here. And the debt service coverage ratio during the same period never falls below 1.45. You can see here. The cogeneration project appears financially feasible when financed on the basis contemplated, even if the interest cost of project debt should rise to 14%. Nevertheless, if interest rates were to rise above 14%, so something like that, the coverage ratio would deteriorate further and would at some point jeopardize the sponsor's ability to raise the amount of debt financing contemplated. To eliminate this risk, the sponsors could pre-finance or else purchase some form of interest rate protection. If the electric power purchase, steam purchase, construction, and gas supply agreements were not in place, then additional sensitivity analysis like those presented here, and probably you can check it here, should be taken into account. So, for example, similar to the analysis, sensitivity analysis of the interest coverage ratios and debt service coverage ratios to the interest rate, we can perform the sensitivity analysis for changes in the base price for electricity megawatt per hour and the growth factor, as well as for output. So, for example, what would be the maximum output of the electric plant? You can see here that it can be easily done in Excel or other financial tools. And to check the this frontier where the efficiency deteriorates, like here at a price of electricity $25 per megawatt hour and the growth rate of 9%, you can see here that probably it will be minimum acceptable combination. So if the growth rate for electricity price will be lower, then you will have a negative effect. And the same for capacity. Okay. Any questions regarding the description of this cogeneration project? Please let me know if you have something to discuss. Probably we can discuss anything else regarding the course. So I again recommend you to become familiar with this Excel spreadsheet I gave to you, because we will have a few but very interesting tasks that can you do manually on the basis of this Excel spreadsheet. Probably they will be focused on sensitivity analysis part. It will come later after we will finish the sessions devoted to the risk management. So again, please become acquainted with these Excel files. And I will now proceed to the next topic. That is an due diligence and risk analysis. Okay. You want to send me the Excel file to the chat, right? Okay. Just a minute. I will send it to you here. So, you received it. Okay. Okay. So here you are. Okay. Move to the due diligence and risk analysis. Very important topic. A project may be financed by a company as addition to its existing business rather than on a standalone project finance basis. And in this case, the company uses its available cash and credit lines to pay for the project. And if necessary, raise new credit lines and new equity capital to do so. So it makes use of a corporate finance. Provided it can be supported by the company balance sheet and earnings record, a corporate loan to finance a project is normally relatively simple, quick, and cheap to arrange. A project company, unlike a corporate borrower, has no business record to serve as a basis for lending decision. Nonetheless, lenders have to be confident that they will be repaid, especially taking account of the additional risk from the high level of debt inherent in a project finance transactions. This means that they need to have a high degree of confidence that the project can be completed on time, on budget, is technically capable of operating as designed, and that there will be enough net cash from the project's operation to cover the debt service adequately. Just recalling all the definitions of the project, so on time, on budget, and enough cash flow to cover for at least lenders' requirements. Project economics also need to be robust enough to cover any temporary problems that may arise. The lenders, therefore, need to evaluate the terms of the project's contracts, and so far as these provide a basis for its construction cost and operating cash flow and quantity, the risk, and the lenders have to quantify the risk inherent in the project with particular care. They need to ensure that project risks are allocated to appropriate parties over that the project company, or where there is not possible, mitigated in other ways. That is one of the core concepts of the project finance. You have a lot of and various risks inherent to the project finance, but it is not the case when the general partner or managing company or general sponsor should bear all these risks. The concept of project finance led us to the principle where the risk should be allocated to the party that can bear this risk, can manage or mitigate this risk in most efficient manner, and there is no problem at all for allocating, for example, this risk to some party when you the project will goes better with it. For example, if you have a project of say redevelopment of some recreational area, and you have the management team for this project, some contractors for construction of additional properties or redevelopment of existing properties, and you have local authorities that, for example, represents the departments for recreation, tourism, etc. for that region, and you have some lenders or financial development financial institutions that is interesting both in lending money but also in developing the land, developing the rural and urban area of this region. So, and you identify that within this project, for example, exists some legal risks connected with the unsettled questions about the property rights for the land plot. So it is not efficient way to leave this risk for the project company or for the management of this properties or area, etc., or for the construction contractor. The most efficient way, first, probably to allocate this risk to the local authority, because they have enough power in this region, they have a legal expertise, they have professional staff, and they probably will find a solution in such cases when this land rights risk will be realized. And the second best option is to assign some portion of such risk to development financial institution, because first it's a huge organization with a lot of resources, both financial and legal and others, and also it is their part of the participation of the project to deal with such risks that's more first in the area of responsibility of such parties of the project, and they feed to their capacities. So again, that is the core concept. The risk should be allocated to more suitable party of the project, and that risk, after it's been allocated, should be clearly stated in a project document. So there should be no issue when such a risk realized to whom address this risk and who is responsible to mitigating such a risk. So this process of overall evaluation and designing the risk mitigation schemes is known as due diligence. The due diligence process may often cause slow and frustrating process for a project developer, as lenders inevitably tend to get involved directly or indirectly in the negotiation of the project contracts. But it is an unavoidable aspect of raising project finance debt. Risk evaluation is at heart of the project finance. Project risk analysis is based on a due diligence process attendant to ensure that all the necessary information about the project is available, identification of project risks based on this due diligence, allocation of risks to appropriate parties of the project through provisions in the project contracts, quantifying and considering the acceptability of the residual risks that remain with the project company and hence with its lenders. So of course there can be risks that you cannot efficiently allocate to various parties of the project, but then you have to quantify this risk and think about, is it acceptable for the project company or not? And what about the risk allocation principles? Of course, due diligence and risk assessment is not procedures, so they are procedures peculiar to project finance. And all financing involves risk in some way. but the process of contractual risk allocation and raising finance based on this are particular characteristics of project finance. The theoretical principle of risk allocation in project finance is that risks should be borne by those who are best able to control or manage them and to bear their financial consequences. That I was told about. And for example, the risk of late project completion and its financial consequences for the project should ultimately be borne by the construction contractor, unless this late project completion arises from events outside the construction contractor's control, in which case insurance may be step in to take such risks. Risk and the project company. Other parties to project contracts have to recognize that the project company's ability to absorb risk is limited if it wishes to raise highly leveraged project finance. It is no use allocating risk to a party who cannot sustain the financial consequences of the risk materialized. Similarly, if the contracting authority who entered in a contract for purchasing the proceeds of the project wish to achieve the lowest possible contract payment, this usually implies that it must absorb a higher level of risk. A common error in the early development and negotiation of project contracts is to leave too much risk with the project company, which causes problems later when raising the finance. On the other hand, transfer all risk away from the project company to other parties is not viable if other parties are asked to assume too much of the risk. They also expect the appropriate equity return for doing so, with obvious consequences for investors in the project company. So you have to balance this distribution of risk that will leave on the project company and be transferred to the other parties. And risk and value for money. When some contracting authorities consider the extent to which the risk should be transferred to a project company, key issue is whether such risk transfer can be considered value for money. Almost any risk can be transferred at a price, but if the contractor authority tries to push risk onto the shoulders of the project company, which the latter cannot easily manage, the project company will include a large safety margin to cover such risk in contract payment proposals. Paying for this safety margin may be a wasted expense of the contracting authority, and so it may therefore be better value for money for the contracting authority to retain this risk itself. Let me explain it on the example I have in the city of Volgograd. Probably all of you know the city under different names. That is Stalingrad. It's the turning point battle in the Second World War, and the city is situated on the banks of the River Volga. It has probably the longest tram line in Russia, and it's even goes underground, so partially it can be called the light metro. But the problem was that it's really absolute. So the trams are maybe one of the oldest all in Russia, and we have approached the local municipal authority on this concession project to first redesign the transportation schemes for the Volgograd city, and then to reconstruct the tram lines, to provide the locomotive engines, carriages, etc., and finally probably even to manage these lines. But there was an interesting point that the local authorities was insisting. So the existing municipal entity who serves these tram lines has a debt around 1 billion rubles, and they want to include this debt as a part of the assets that and liabilities that should be transferred to the concession company under such a contract. That means they will just write off this debt from this balance sheet, but that this, after all calculations and quantifications of the debt ratio, it highly increase the debt to equity ratio on the project companies. So it was really at the level that is unacceptable by even a huge development financial institutions like Corporation Web. So but still it was really hard, and probably still hard, because the project is stalled, to persuade local authority to leave this debt on their balance sheet, not to include it in the project provisions that will allow to receive more finance from financial institutions like Web and to run the project. So you see that sometimes there is no consensus among parties of the project for effective allocation of different risks, and not loading the project company with much obligations to serve, for example, risk, to provide some services, to pay some higher fees for entering the contract. But still, on the overall, the picture will be better if, for example, in this example of, in this case, the local authority will leave this loan on its balance sheet. But as it goes, the city of Volgograd still using the old trams, and there is no movement on this debt on the balance sheet of the municipal transportation entity. So and the money, the time and the money is wasted. Now to run such a project, reconstruction and redevelopment project, it needs 3 to 5 times more investment as it was 3 years ago. So please be aware of such possible situations and try to optimally allocate risks, revenues, and returns among different various parties of the project. And then, what if we will consider the risk and the lenders? As to risk allocation between sponsors and lenders, one basic fact has to be kept in mind. Sponsors and other investors have upside and downside. That is, if project goes well, they will earn better return on the investment, but if it goes badly, they may lose money. Lenders, on the contrary, have only downside. If project goes well, they don't benefit, as their loan terms are fixed, whereas if it goes badly, they may lose money. It follows from that the risk minimization is a key principle for the lenders. So as the saying goes, a banker is a man who lends you his umbrella when it is not raining. And when it is raining, he's asking you to give the umbrella back and maybe additional payment. Thus, the lenders are not investors in the projects, although sponsors may use this expression in the heat of negotiation. If the lenders were investors, they would get an equity rate of return, but they do not. Typically, in a successful project, the gross rate of return on the equity is at least twice that on the debt, which reflects the different risks taken by investors and lenders. As the ability of the project company itself to absorb risk is limited by the low levels of its equity, this may mean in some cases transfer of risk from the project company to the sponsors. It should be noted that risk assessment by lenders is based as much on the financial impact that is particular risk may have on the project's viability as on the likelihood of it's actually happening. So a low probability, high impact risk is one that will usually concern the lenders. Again, a reference to alternative investments. So this particular distribution of returns, low probability, but high impact. As a result, sponsors may feel that the lenders concentrate on risks that are unlikely to arise and therefore of little commercial importance. But it's really important for the lenders, and you should now understand why, because it's the nature of such investments. So let's us now look through the different categories of the project risk. Project finance risk can be divided into four major categories. Commercial risks, also known as project risks, are those inherent to the project itself or market in which it operates. Macroeconomic risks, also known as financial risks, relate to external economics effect not directly related to the project. For example, inflation, interest rates, currency exchange rates, etc. And the to left, regulatory and political risks, that is change in law or risk which relate to the effects of government actions or political force majeure events such as war or civil disturbance. And the latter are also known as country risks that are especially but not exclusively relevant if the project involves cross-border financing or investment. And let us talk about the risk identification and the subsequent minimization procedures. Commercial risks. The main questions to be considered in the commercial risk analysis process can be summarized as the commercial viability. Does the project make overall commercial sense for all parties? Construction risks. Can the project be built on time or on budget? Revenue risks. Will its operating revenues be as projected? Operating risks. Is the project capable of operating and the projected performance level and costs? Uninsured risks. Are there significant risks not covered by insurance? Environmental risks. What effect will the project have on its surrounding environment? Residual value risk. What happens to the project after the end of the project agreement? Contract mismatch. Does the project contract fit together properly? Sponsor support. Is there a need for more recourse to the sponsors? Risk for the off-taker or contracting authority. Are these reasonably allocated? Loss on default. What level of loss can a lender expect if the project does in fact default? And I want to share with you this instrument called the risk matrix. The due diligence process examines the risk inherent in the project under these different headings. You can see the extent to which these are covered or mitigated by contractual agreements, or whether remaining risks left with the project company are reasonable and acceptable to lenders. One standard approach to this is to procedure a risk matrix table, which set out the columns, what the risk is, whether it's covered in the project contracts or not, what are the mitigation there is for risk not covered contractually, for example, through guarantees or insurance contracts, what impact the risk that remains would have on the project company and has effectively on the lenders. The final effect of risk allocation within the project agreement will be reflected in the classification of risks as compensation events, excusing causes, or relief events. So far as they are not listed in the project agreement with any of these categories, risks will lie with the project company. However, the project company may transfer this risk to a subcontractor by dealing with the effect on the relevant subcontract. So, for example, a risk which is not covered by a project agreement, such as late project completion, may give rise to a claim against the construction contractor. That is, the construction contractor will have to compensate the project company should the risk crystallize. In some cases, risk may be taken out by sponsors. And let's go step by step through these risks. The commercial viability. First step in the due diligence for any project is to consider its basic commercial viability. That is, if there's a sound market for the product or service provided by the project company. This initial question has nothing to do with the terms of any contract signed by the project company. Project finance is a long-term business, and long-term contracts that give an undue advantage to one side is vulnerable. It is impossible to provide in advance for every event that may affect a project contract in the future. And an aggregate party will obviously take advantage of any flow to get out of an onerous obligation. Therefore, the deal underlying any project contract should make good long-term commercial sense for both parties. Questions that may be considered in examining commercial viability include: is there any established market for the project products or services? What competition exists or may exist in this market in the future? Is the price at which the product or service is being sold reasonable in relation to the existing market? And does it take adequate account of future competition? Is technology proven? Can any major structural changes in the market, for example, deregulation or new technology, be foreseen? And what might be the effect of this? Are all the players in the same market facing any particular difficulties? Is there anything that would prevent the project operating normally when compete? For example, grid connections to a power station, connecting roads for a bridge, input supply delivery, etc. And have arrangements been made to ensure that this is dealt with? Here are some examples of types of projects that have an apparently sound contractual structure, but which are not commercially viable. So first, the construction contractor has quoted too low price, perhaps because of the insufficient experience in this sector. A construction contractor who finds that there is going to be a loss on a construction contract will use every loophole which can be found in the contract terms and specifications to claim more money for a job. Such disputes may seriously delay the project and affect its overall viability. The cost of product or service sold on a project agreement is not competitive with current prices for the same product or service, or too high in relation to the ability of end users to pay for it. So in this case, contracting authority squeezed between the project company and the end users will inevitably try to find a way out of the contract. So if you make mistakes in assessing the market capacity and market prices, and you put your prices is too high, and the contracting authority who is obliged to purchase your services and products and the specified prices will realize this situation in the course of the project, it will try to move out at any possible opportunity. And the third example, an input supplier relying on the open market to resource supplies face a large increase in the free market prices for the product concerned, which is not reflected in the long-term sales price in the input supply contract, because the contract price is not linked to the free market price. Disputes and even default in an input supply contract is highly likely. So if you are not include the provision of adjusting prices for supplies, input supplies that are provided to you, in a case if it is some sudden changes in the market prices, for example, as now in all the world the inflation is roaring and the prices for all commodities, all supplies are growing and growing, that it's virtually unevitable for supplier to try to get out of the contracts if he cannot increase the prices and market to market. So please again consider such examples and try to be fair enough in your assessment of the market and in your contracts. Do not to try to catch a contractor or supplier in some trap when he or she has to pay an additional unjustified premium for your answer in terms of higher prices for purchase of your services, or lower prices for supplying you something, because the very nature of project finance is a long term, and it's still it cannot be long enough for supplier or purchaser to contain within such a uneven and inadequate situation. So they will try to move out as soon as possible from such stories. But if you have some provisions in a contract that allow you and your counterparty to efficiently justify in relation to the current market the pricing of your agreements, that will help you to stay as partners as long as possible and for your project to be well. Let us have a break for 10 minutes because we have a lot to discuss. More about the construction costs, etc. Please have a rest and then we will proceed. Meet you in 10 minutes. If you have again some questions regarding material course, or probably again we have a new attendee of our call who did not find themselves in a Excel spreadsheet with a list of those whose homeworks I have received, please let me know. And also again I kindly ask you to advise your fellow students, try to check this list or submit the homework today, because today is the final day for submitting the homework. Good. 10 minutes break. Okay, welcome back. And let us discuss construction risks. The first detailed due diligence question is whether the project can be completed on time, on budget, and to required specification. This question obviously mainly revolves around the risks inherent in the construction process. The key construction phase risks include site acquisition and access, site condition, permits, risks relating to the construction contractor, construction contract related costs and runs, delay in the project completion, and third-party risks. Site acquisition and access. Lenders will not normally take on this risk, and therefore only lend when the project company can have present a clear title and access to the project site and any additional land needed during construction. This is mainly likely to be a problem in a linear infrastructure project. For example, where land has to be acquired for a road or a railway line and acquisition is not complete at the time construction on one part of the project begins. The PPPs, public-private partnerships, it is common for a site acquisition to be responsibility of contracting authority, so local authority, for example, since this often involves acquiring large areas of land in a multiple ownerships for which public sector compulsory purchase powers may be needed. Site condition. There are a variety of ways in which the condition of the project site may affect construction, either by increasing the cost of construction or causing delays in project completion, or both. Geological structure. Generally speaking, the construction contractor should accept the risk of problems with the geology, for example, affecting foundation or pilling costs. Test borings before the construction contract is signed, perhaps carried out by the project company or contracting authority, can be helpful in this respect, although this can never provide a 100% certainty that there is no problem that has not been picked up by the survey. The problem can be especially acute in a linear projects, like that is projects that not occurring on one side by being built over a long stretch of land where a detailed site investigation may be impossible, such as road, pipeline, or electricity grid line. Previous use. The way in which a project site has been used in the past may create risks for construction on the site. Lenders certainly prefer to see projects being built on a greenfield rather than brownfield site. Previous heavy commercial or industrial use is one warning sign. Conversely, land which has been used for farming, residential property, offices, or warehouses would usually be considered low risk. A high risk may have to be treated as a compensation event under both project agreement and the construction contract. And here example from my experience. If probably you know this shopping mall Oceania on Kutuzovsky Prospect in Moscow. And during construction, there was some accident, unexpected accident related to the project that is has its history from the previous use of this project. So, for example, below this shopping mall was a bomb shelter that was built during the Second World War. It was built of highly durable concrete, M500. And it was not possible to somehow redesign this bomb shelter or do something for it, because it should be exist in a defense purposes, and the only solution was but it's a good solution, was to construct a metro station, nearest metro station, that is Slavyansky Boulevard, with a spacious additional rooms under the surface that can be served as a bomb shelter. So the company and the local authority first agreed to remove the existing bomb shelter and then to construct some proxy of such a bomb shelter adjacent to suburban station Slavyansky Boulevard. And the second example, again with this shopping mall, the collector, sewage collector used for the local community. So the local community and the residential area was constructed in the mid of 60s and 70s, and there was banks of now enclosed in a tubes river, and there is a sewage collector that collects the sewage for all the area of adjacent neighborhoods, and it's was not accounted for the huge increase in the capacity needed. And the problem is that the shopping mall was constructed over this sewage collector. The capacity that will be used by the shopping mall was considered. It was included in the calculation, so the existing capacity of the sewage collector was enough to accommodate the capacity from the shopping mall. But after the probably was already on the initial final stage or stage of construction, the nearest neighborhoods was allocated for construction of new, very huge and highly and densely populated residential complexes like Dynasty, probably some of you know it, and all these huge should go to the collector, and its collector already below the shopping mall. So it's no efficient way to somehow reconstruct, extract this collector, etc. So this problem exists, and probably no one knows how it will be dealt in the next years. So please, if you looking for acquiring apartment in this area, be aware that there's some problem with huge system, and it, of course, it can be dealt with, but at higher costs. And personally, I don't know how it can be done now. So again, latent defects. The same principle applies to structures which will form a part of the project and so remain on the site. In some cases, the condition of the assets cannot be easily ascertained. There may be a latent defects in old buildings, bridges, or tunnels, and clearly the lenders will not wish the project company to take on unknown risks of this type. Pre-existing contamination or discoveries at the site. Extra cost can be caused by delays due to the discovery of fossils, archaeological remains, human remains, and so on. Again, this is a risk which would normally be assumed by the construction contractor. If such problems are unexpected and therefore have not been dealt with in the project contracts, the main mitigation for the lenders, from the lender's point of view, is that the risk of this nature should be apparent at an early stage of construction, when the project costs are probably not yet exceeded the amount of the equity investment, and therefore they can stop advancing funds if any major issues of this type arise, with their risk covered by the equity. And here examples, again, from the Russian experience and international practice. The very same shopping mall Oceania on the Kutuzovsky Prospect, there was an accident during construction. They will find an air bomb, very huge air bomb that was dropped in during the Second World War when the Nazis bombed Moscow, and its extraction and subsequent demolition instruction take about 1 week. So 1 week full stop of construction on the construction site, and also the risk of the explosion of such bomb that can probably cause the damage for this surrounding residential area. Second example is the findings of human remains. And here we go to London. In the city of London, there is really a lot of remains, for example, of first temples of London, the human fossils, some animal fossils from very old history. And it often leads not only for delaying construction, but also for some new solution have to be found to allow these remains and historical archaeological sites to be preserved. For example, this very first bridge of London, its remains was transferred from original construction site for a commercial center. So these projects has additional costs of first extracting these remains, then moving them to the next site, to the new site, and then to continue the construction of the commercial center. But in this case, the Authority of London often helps to keep these findings and move it to a designated space. So please be aware of such situations when you can experience not only construction delays, but also an increase in the construction costs. And the permits, lenders generally require construction permits to be obtained before any funds are advanced to ensure that failure to obtain such permits does not delay project completion. If for a good reason such permits cannot be obtained at this stage, a specific timetable for obtaining them is normally established with lenders. Where possible, lenders prefer the risk of obtaining this later permits to be placed on the construction contractor, who thus becomes responsible for any delay caused by a failure to obtain them. Rights of way, easements may be difficult where this involves parties not otherwise connected with the project, and the construction contractor is unlikely to take the risk of obtaining this. Lenders will be uncomfortable if these are not obtained prior to financial close. Final project completion may also be dependent on obtaining operating permits that confirm that the project meets emissions or other environmental requirements or health and safety regulation. Often this cannot be obtained in advance, but obtaining such permits or meeting the requirements to obtain them should, where possible, be obligation of the construction contractor. If this is made a condition for reaching project completion under the construction contract, the risk of failure to obtain operating permits is thus transferred to the construction contractor. Please recall this project of Nord Stream 2, Nord Stream 2. So now there is no impediments of completing the construction, but still there is impediment to operate the construction pipeline because it doesn't meet the required ecological standards. So still there is no permit from the local German authority to run this pipeline. And again, there is foreseen a second set of impediments, like, okay, probably you will receive some certification for the construction of the operating company, but you know that under the German law, the operating company should be incorporated in Germany, while your company is is Netherlands company, if I recall correctly. So probably you need to set up a German entity for operating company, and then again walk through all the process of certification, acquiring permits, etc. So in a sense, all the regulation risks and some certification risks, this Nord Stream 2 project is very bad. Yeah, let's go to the next set of risks. It's construction risks, that is counterparty risks. The counterparty risk in projects need to be identified and analyzed. These risks, mainly related to technical and financial capacity, relate to all parties with which the project company has contracts or subcontracts. This could include the construction contractor, contracting authority, and others. The risk related to a project counterparty is less if that party can be replaced easily, which may be the case with operation and maintenance contractor, but not with a construction contractor. So it's really hard to switch from one construction contractor to another in the course of construction. Counterparty risk analysis of the construction contractor takes account of competence to undertake the work, technology risk, position of a sponsor, it is relevant, level of direct involvement in the construction contract, whether the pricing for the work is appropriate, the scale of the construction contract in relation to the size of the construction contractor, the construction contractor's overall credit standing. This type of counterparty review is a fundamental first step before considering risk allocation in the construction contract itself. So let's go through these points in details. Competence. The construction contractor plays a vital role in most projects, and therefore the first step in a risk assessment is to consider whether the construction contractor is adequately qualified for this, with sufficient experienced personnel to undertake the job. It is unlikely that the finance could be raised for any project where lenders are not convinced that the construction contractor has a good record in a similar project. Clearly, the more complex the construction of the project, the more this becomes an issue. There would be a less concern about the ability to build a school compared with the ability to build a power station. Technology risk. This is maybe an issue typically with the EPC contracts. The EPC contracts, the engineering, procurement, and construction contracts. So you should assess whether technology employed is efficient, can be easily achieved, etc. The construction contractor acting as a sponsor that is also the construction contractor, has an obvious conflict of interest between this role and that of the investor in the project company. The risk of inappropriate contractual agreements or a less than rigorous supervision of the construction contract is evident. And lenders therefore have to be satisfied that EPC relationship is an arm's length basis. So if you're both acting as a contractor, as a sponsor, both, that you have probably the conflict of interest, like setting the higher prices for the contract and receiving unjustified revenue or income, and also the conflict of interest of in the case of supervision, you probably can untighten the supervision of construction is if you are a sponsor. Then the problem of limited involvement in the contract. A construction contractor normally subcontracts a significant part of the contract. For example, a lead contractor whose primary business is that of equipment supply will normally subcontract as the civil works to the subcontractors. This process, however, can be carried too far if construction contractor is not a significant supplier or either equipment or civil works to the project, but just provides an envelope for a contract largely carried out by subcontractors. The construction contractor may have insufficient experienced personnel in-house and rely too much on the subcontractors. And we have probably in our local practice and all the risks associated with this situation, where the contractor that is acting as an envelope takes unnormal portion of the revenues to itself. So it's can be the case in some state procurement tenders where you're bidding for some state contract, you receive it, you take the major part of the profit and subcontract the rest to the other companies, and that leads to a situation when you have loose control on the activities performed by subcontracts, and again the quality of these subcontracts will be lower by default, because given this economical situation when the general contractor takes the majority of the profit, it will definitely lead to the lower quality of the subcontractors. And this situation when construction contract price too low or too high can also be for the main contractor. So the risk of the construction contractor offering too low a price, however attractive this might seem at the first sight, and conversely, a price that is too high suggests at best that there is not an arm's length relationship with a construction contractor, which is likely to leave the project's company lenders in a weak position if something goes wrong, and at worst, that corruption is involved. And in my experience, we have the following practice to mitigate both sides of this issue, where you have a too low or too high price. So in each contract for construction, we try to compare our prices to this average price on the market by providing an analysis of, for example, if we have to construct some 1,000 square meters, then how much it costs on the market for the concrete works, for masonry works, and then for some internal furnishing, etc., etc., etc. And both this data included our in-house information based on a previously realized project, but also market research. So it really proved to be a solid analysis base for lenders to decide whether the prices for construction are justified or not. So please, again, if you will have such projects, use this experience. Scale of construction contract. The construction contract should not be excessively large in relation to the construction contractor's other businesses, as otherwise there is a risk that if the construction contract gets into trouble, the construction contractor might not be able to deal with such problems because of their financial effect on the business as a whole. The scale of the construction contract should therefore be compared with the construction contractor's annual turnover. If it is more than, say, 10% of this figure, The construction contract may be too big for the construction contractor to handle alone, and the joint venture approach with a larger contractor may be preferable. Credit risks. Allocating project risk to a construction contractor is not worthwhile if contractor is not creditworthy. If the construction contractor's wider business gets into financial difficulties, the project is likely to suffer. The credit standing of the construction contractor therefore need to be reviewed to assess whether it could cause any risk to the project. Okay. And finishing this section of issues related to the construction, let us discuss the construction and contract related cost overruns. The effect of an overrun in cost construction phase against the budget on which the funding structure has been based are there may be an insufficient funding available to complete the project, thus forcing the sponsors to invest funds for which they have made no commitment. To avoid the loss of the investment, so you have to invest more to not to lose that you have already invested, or putting them at a severe disadvantages by having to ask the lenders to advance further funds or to agree to new financing arrangements. Even if traditional funding is available, the project cost base and hence debt service costs will thus be increased with no corresponding increase in revenue. Therefore, the investor's return will inevitably be reduced. In the worst case, it could lead to the sponsors abandoning the project because the increased costs destroy its financial viability. From the lender's point of view, any increase in the debt reduces their cover ratios and thus makes the loan more risky. The construction contract is normally by far the largest cost item in the budget, perhaps 60 or 75 of the total budget. And therefore, it is evident that this is the most important item to control. And the relevance of a fixed price turnkey contract in this connection is clear. In a fixed price contract, and if such a fixed price contract is not in place, this adds a major dimension of extra risk to the project. But a so-called fixed price contracts is never 100% fixed, and the risk of the construction contractor making claims for additional payment under various contract provisions has to be considered. These claims come under several categories: delaying commencement of works, site risks, design risks. And this design risk applies to most projects. The issue here, firstly, has the design been sufficiently completed so that the project costing are not subject to changes required when more detailed design is undertaken? And secondly, is the design unusually complex, which could obviously cause problems during construction? The construction contractor normally carries out detailed design after signature of construction contract, but this is should not lead to changes in construction contract price. There remains a high risk, however, for any project where the overall design and specification are not fully settled in advance in a construction contract, which is not likely to be acceptable to the lenders. And there also can be changes in a contract specification that leads to increase in a contract cost, and again, changes in law. And having said all this, there is strong evidence that the level of overruns and other problems with property structures construction contracts which meet project finance lender requirements is quite low, despite construction often being considered the high risk phase of a project. Okay, and the last slide for the construction. We have other construction phase costs that may lead to the cost overrun. That includes development cost, mobilization costs, insurance premiums, and the other project company costs, also advisory costs, and very important, contingency reserve and financing costs. What are the development costs? A project development costs are those incurred by a sponsor before financial close. So it might seem that there cannot be an overrun on this cost during the construction phase. However, there is often a time gap between when the construction budget is agreed with lenders and financial close. And during that time, there is a risk that legal or similar costs may mount up more than budgeted. Mobilization and operation maintenance contract. Mobilization costs, the costs of training staff to operate the project, are often covered by the construction contractor on a fixed price basis and therefore should not pose any undue risk. Insurance premiums. The insurance premiums for the construction phase are fixed at the beginning of period, and therefore they should not cause any cost overruns, unless there is a gap in time between the final budget and final cost. Advisory costs. If changes in any of the project contracts are become necessary, so that lawyers and financial advisors are brought back into the picture, there is likely to add considerably to advisory costs during the phase of the project. So advisory costs should be considered carefully. And also there is a project's company own costs. There is these are any remaining categories of costs not covered above and which continue after financial close. The main items are likely to be the costs of the project company, offices, office equipment and staff, and continuing payments to advisors such as owner's engineer. These amounts should be relatively small in the context of overall project costs, and it should be not difficult to ensure that such items remain close to budget. And it comes to the contingency reserve. However well managed the budget, there is also always a risk of unexpected events causing a cost overrun. Despite all the risk mitigation set out above, a contingency reserve covered by matching funding is also often required by lenders. As a rough rule of thumb, a contingency of around 10% of the construction costs or 7 to 8% of the total project costs may be needed. The contingency is also intended to cover the effect of delays in the project completion. And as I say, as I can assure you from my own experience, yes, the 10% of the contingency reserve based on the cost of the construction is the industry standard, and it can be as much as 15%. And if you meet this 10% contingency reserve and not going more, it's a good project. It's a good construction project. So please consider the refurbishment of your flat. So if you are entering a new flat or just changing the old one, so this ongoing repair, is there any estimates that exist on the market how much it can take? So probably you already know, if you bought a flat or apartment with only so it's no shell and core, just concrete, so Nothing done instead of only rough walls and the floor and the ceiling, then probably the cost of making this apartment or flat livable, so this construction and repairment cost will amount pretty the same amount of money. So that's the case in our real life, but in huge construction projects we have a contingency reserve of 10%. That is good. So okay, let us have a break now for 5 minutes, and I will answer to Luca because he has some questions here. So 5 minutes break. Okay, let's continue to revenue risks. The risk that the project company may not earn sufficient revenue to service its operating costs and debt and produce an adequate return for investors is the heart of project finance. If the project is producing a product, the risk is whether, assuming it is able to operate as projected, the project company can achieve the volume of unit sales projected, that is the volume risk, and at the projected unit sales price, that is the price risk. These risks may be covered by a purchase contract or a take contract or other similar arrangements, or the project company may take the risk of sales into a competitive market. In the case of an infrastructure project, either privatized or a PPP concession, the key revenue risk is typically whether the project company can achieve the volume of usage of the service projected at the projected toll, fare, or other usage charge. So it is a usage risk. In availability-based project agreement, the usage risk is most commonly taken by the contracting authority, so that the primary revenue risk is the ability of the contracting authority to make the contract payments when due. The availability and other types of contract agreements we will discuss later, but in short words, it is a contract when your contracting authority, like you, the local municipal authority for which you build a toll bridge, agreed to pay you some amount of money for example, for a specific volume of fares through the bridge, if your actual fares is below the bridge, so below this number. So you expect to have, for example, 5,000 crosses or users of this toll bridge per day, that for some reason it's only 2,000 crosses or users of pay bridge per day, but your availability contract have a provision that the contracting authorities, and can be a local municipality, will cover at least 3,000 users of the bridge per day, then you will receive this money. That's how it works in a few words. The risk of penalties or deductions from public-private partnership contract revenues related to ability or performance will be discussed later. So let us check the offtake contract. So in take or pay offtake contract, both the volume and price risks are transferred to the offtaker, so who purchase your services. In principle, then no significant revenue risk is left with the project company. It follows from this that a process planned project with this type of contract can achieve the highest debt leverage and hence offer a lower production price. The main remaining risk for the project company with offtake contract is the ability of the offtaker to pay for the product. The project company and its lenders are in fact taking a very long-term credit risk on an offtaker. So recall our example of cogeneration company. You have an offtake contract with local gas and steam facilities, and the credit risk that the lenders to your project should take into account is really by its nature the credit risk of this local gas and utility facilities. Hedging contracts. These are normally concluded with market intermediaries rather than end users of the project. The risk that remains with the project company is credit risk of the intermediary. For example, a commodity trading company. Contracts for differences. CFDs are commonly used in the electricity industry. Because such contracts are primarily used because power cannot be sold directly to the end users, the risks involved are very similar to those of an offtake contract. The main additional risk that the project company may still be taking under such agreement is that it has to sell the power produced to the grid or electricity system. And we have a long-term sales contracts. A long-term sales contract removes the volume risk from the project company, but leaves it with price risk. Such a contract may be appropriate if the product produced by the project is a commodity that is not sold in a widely traded markets and requires a sales organization to sell the project, as say in the case with petrochemical products. Or if the end user is willing to contract for the product on a long-term basis, but wish to index the price to a commodity market. For example, in a long-term contracts for the sales of liquefied natural gas, there is a price where the price is often linked to that of oil. In such cases, lenders will wish to ensure that there is a clearly defined pricing basis for the product. So to the extent of the price risk can be measured. It is clearly preferable for pricing to be based on some widely traded index such as oil prices, since price projections are easier for such commodity markets. Okay. And we have a very interesting type of agreements. It's the concession agreements. Usage is the main risk in a concession agreement or private sector infrastructure project. That is, whether users will use the project in sufficient numbers and thus create the revenues projected for the project. Similar principles apply to privatized infrastructure such as ports and airports. The most common projects of this type are concessions involving roads, including bridges and tunnels, often financed as a separate project to improve an existing road. So this issue will be discussed here by us in the context of toll road. Finance can only be raised for a toll project where there is a clearly established demand. For example, a project may consist of building a tolled bridge alongside an existing one to add capacity. The established traffic flows make projections of future toll revenues relatively easy. The risk assessment is more difficult if, for example, a toll road is to be built near to other roads with no toll. Similarly, there may be a competing transport mode such as rail. In these cases, however, if the current demand is clearly demonstrated by congestion of the roads and the cost of tolls or fares is reasonable in relation to the cost of existing transport modes, lenders are willing to take the usage risk. Usage projections for transportation projects are based on complex financial modeling by the project company's traffic consultants, which in turn is reviewing the lender's traffic advisors. Modeling of usage is based on projections that take into account factors such as overall population growth, distribution and movement, general and local economy activity, land use around the area of project, travel at different times of the day or different seasons, distribution of travel, origins and destination trips, split between commercial and private traffic, split between modes of travel such as bus, car, and train, the value of time saved by users compared to the toll. Just make a short notice here that the city of Moscow is heavily using such models, and probably some of you already can see the changes in a municipal transport system of Moscow, where we have really good new roads for the electrobuses. We have a new types of new modes of transportation, like not buses, not trolleys, not trams, but electrobus. We have a lot of this last mile means of transportation, like this electro bikes. You have car sharing, etc., etc. And really, it all goes from the very complex and diversified model that employs modern techniques like neurointelligence, machine learning, object recognition via some specific models. So you have a satellite map of the Moscow city. You can identify traffic jams. You can identify origins and destinations of the traffic. So probably some of you can share his or her attitude to the changes of system of transportation for Moscow. That I will be very grateful to you if you can share, because in some projects I was involved with such development. And coming back to this toll road example, these factors combine to produce a model of current traffic patterns, which it should be possible to validate by using it to project traffic growth from a date in the past to the present and comparing the result with actual growth figures. Future projections of a traffic growth for project finance purposes are based on microeconomic factors such as growth in a national and regional economy, leading to growth in the private and commercial vehicle ownership, and generally do not take into account extra traffic that may be created by the construction of the project itself. Any project involving traffic risk also has to take into account the effect of government policies on usage. These policies may be local to the project or national, but affect the project. For example, an increase in fuel prices that reduces road traffic volume in general. But it's not the case really here in Russia. Lenders often require some protection against some of the risk of this type to be built into concession agreement. So let us summarize all that above. What is the result of all this? Firstly, the rate of failure in toll roads is significantly higher than in other infrastructure projects. Secondly, in many cases, the contracting authority recognizes that transfer of usage risk is inappropriate. Various solutions can be adopted for bringing in private capital. For example, the contracting authority may provide partial finance or a guarantee to reduce the usage risk. Shadow tolls may be applied to the project, which tends to reduce, although not eliminate, the traffic risk. The more common solution is to switch to using an availability-based contract, as we discussed previously. Tolls may still be charged by the revenues from this go to the contracting authority to help offset the availability-based contract payments. So there can be provisions that can share the excess profit between the contracting authority and the concessor. So what is the present value of revenues? And another solution to the traffic risk issue, but which has not been widely adopted, is the present of revenue system, which originates in Chile.
In this structure, bidders bid for a concession agreement which will not terminate at a fixed date. But when the NPV of the toll revenues reach the certain figure, so you will be still entitled and have power to use the toll road you built and getting the tolls from this road until you receive some pre-specified value of NPV given all the other assumptions like your required risk of rate of return, etc. So it's very interesting innovation comes from Chile. And a few words in detail about the availability-based contracts. The contracting authority takes the usage and has the revenue risk on this type of projects. Just as in private public agreement, the off-taker has to pay the capacity charge, whether or not it needs the electricity to be generated. So if the demand for school places or number of prisoners in a prison is lower than projected, the service fee is still payable. And again, if the number of users of toll bridge is lower than projected, then these fees will be paid in a predefined value. And the project company does not suffer. This is logical because the contracting authority controls the usage of the service provided by this project, directly or indirectly. And it should clearly take the risk in the same way as an off-taker or contractor in other contracts. But long-term usage risk can produce problems for this as a very specific contracting authority. Just a few words about the operating risk. This slide will be the last for today. So once the project has been completed and demonstrated to be operating to specification, a new risk phase begins, that of long-term operation. Even if the project company has hedged many of its risks through a project agreement, some level of operating risk is likely to be left with project company, and therefore this aspect of risks and their cost consequences are closely reviewed. Preliminary issues that will concern us in this respect include how the project company's operations will be managed. What are the track records and skills for those involved? And to what extent it will be able to receive technical or similar support from the sponsors. Operating risk issues relating to projects would include technology, general operation and of the project, performance degradation, availability and performance. There is also a number of risks relating to potential overruns and the project's company own costs, which need to be taken into account and are dealt with separately as examples of common issues for different types of contracts, like maintenance, utilities, and the project company's other operating costs. And also the insurance coverage is also important, can lead to the project cost overruns. So let us have a stop here. We will leave environmental risks, very interesting and new to not new, but of growing concern for the project finance and the project management. And we'll continue with very intense in a sense of calculation and financial techniques usage topic about the how to manage, mitigate, and analyze financial or risk of the project. So I have few questions from you, mostly regarding the how we can get the mails, any problems with communication. Sure, I will check your mails. Probably some of these mails are gone to the spam folder. It sometimes happen. So please excuse if I miss something, but don't be shy, please raise a hand, type your question, or you can send the repeating mail for me. So no problem with communication. Please address on any issues regarding the course, materials, etc. And also I will now, as a reply letter, send you the slides for this session. So I would like to thank you for the time. I'm ready to answer at any questions if you had now at hand. And generally, again, thank you and have a good weekend. So thanks. Yes.